Good afternoon, everyone. Welcome to today's market stream. My name is Stock Darts, and we're going to do what we normally do on Wednesdays. We're going to go ahead and take a look at the four major market indices. We're going to look at the S&P 500, the Nasdaq Composite, the Dow Jones, and the Russell 2000. We'll do that through their respective ETFs, the SPY, the Qs, the DIA, and IWM. If you like what you see today, you can always follow me at Stock Darts at Twitter, YouTube Stock Darts, or visit me at patreon.com/stockdarts, where I post weekly blog content and trade ideas. And, basically expound on any of the analysis we come across during these Wednesday webinars or Wednesday market streams. On that, let's go ahead and get started. First thing we're going to take a look at is the S&P 500. We're going to look at the ETF SPY. And, we had a pretty poor close to the week last week, and as we started this week again, we explored a little bit lower. This was not really a surprise. The market was at a bit of a turning point last week, and we kind of outlined exactly where we needed to break through in order to continue our bullish stance. And if not, the likelihood was we were going to continue to correct. And that's what has ended up happening, is we've continued to correct. Now, I still think we're in a bullish market. I don't think anything has really changed that would lead me to believe that we are not that we've topped out or are going to start a longer correction. However, this was something that was necessary, or something that's needed, and truth to be told, it could be even a longer correction than this. Because if you look at it from a long-term perspective, and you look at what we've done this year, basically from April till September, we've just been climbing steadily. Now, we've had a couple of periods of consolidation that maybe don't look like it on the chart here, but we had a month and a half of sideways trading here, and then another month or so sideways trading back in June and July. And so the market has had periods of consolidation, but generally speaking, it's been trading pretty much in a straight line up since we bottomed out in March and the beginning of April. And the market doesn't always just go straight up all the time, just like it doesn't go straight down all the time. And so there are going to be periods of consolidation, periods of broad sideways trading, and it could be that we are getting ready to enter one of those phases. It could also be that we ultimately do top out here, but I don't think we have enough warning signs right now in order for us to get into a situation where we need to worry about that. I think if the market is going to head further south, we'll get more warning signals, and at that point we can go ahead and readjust our stance and our approach to the market. But at the moment, I'm still approaching this as a market where the dips are supposed to be bought. It's just a matter of making sure your timing is correct and understanding what your probabilities of success are during this time. So for those that are maybe wondering what I am doing and what my Patreon subscribers are doing, is we were looking to take long shots if the market was able to bounce, and we did get a bounce over the last couple of days, but we had very strict rules of entry and very strict risk-reward parameters set in place in order to make sure that if a bounce were to occur, we'd profit from it, but we weren't going to just guess and hope it bounces and then maybe get nailed if the market doesn't actually bounce. So we've got a couple trades that are working slowly for us, not as quickly as I'd expected, but they are working because the market is in the process of bouncing, despite the fact that today is actually a red day. Now, what exactly can we expect out of the bounce that we're seeing so far? Well, as of yesterday, it looked like the market was ready to actually start making its way back through the moving averages. But with today's price action, you can see that we are still encountering some selling, and we are still struggling to really maintain an upward bias and to get enough buyers in place to kind of overcome some of the selling pressure that has come in now. As I mentioned, the selling news expected, right? If we go all the way back to September 2nd, which was, I believe, a Wednesday, we discussed, let's make sure, I'm pretty sure it was, yeah, so 3 weeks ago, we were really outlining the fact that the market was ready for a pullback, and there was a lot of psychological and technical reasons for that. The market was getting pretty stretched out. When this happens, you end up getting a situation where there are too many weak buyers that are chasing the price action that are getting involved. Also, you have market makers that have to kind of struggle to take the other side of trades. And when there's only long trades, the market makers have to take a lot of short trades, and market makers always want to be neutral. So that means that they have to balance that out and hedge themselves by taking long plays in the options market usually. So what ends up happening is you get a short squeeze coming, even if it's not really a short squeeze because there are too many shorts. In matter of fact, it's sort of a short squeeze because there aren't enough shorts. And what ends up happening is you have too much of a buying bias because of the traders that are chasing the price action up and market makers that can only take the other side of that trade by remaining neutral, which means, net it's a net bull or bullishness for the stock market, or net long, and eventually that stabilizes and balances out. And what happens is you end up getting the other side of that trade when there's just too much supply left, and eventually the buying dries up. And when that happens, you usually get a violent move back to the downside, which is what we got over the course of 2 days, where we went from about 355 all the way down to a low of maybe 334. So about 20 points in the span of 2 days, even though we did rally a bit to close at 340. And that selling pressure hasn't really completely unwound yet. And so what we have here is we're still getting a lot of selling pressure coming in and impacting the market, and we just don't have the demand right now to be able to push that through. And again, I think that's normal. I think that's what we should expect. There are certain times when the market is going to be trading up. There are certain times when it's going to be trading down. But more often than not, the market tends to find an equilibrium and trade back and forth. And I think right now what the market is doing is trying to find an equilibrium, and is going to continue looking until it finds a good floor where there are enough bulls really ready to support the price action, and to finally confirm what the bottom is going to be for this particular range. Now, I think we're pretty close to that. I think this 320 area is a really good level of support. We discussed that last week, and as a matter of fact 2 weeks ago as well. And as you can see, with the price action this week on Monday, we did finally find some buyers right before we got to that level on SPY, and we formed a nice little hammer candle, and yesterday's hammer candle as well was bullish. Now again, today's candle is not really looking that great at the moment, but we'll see what happens as we approach the close, and whether this is going to be another one of these little bear flags as we continue to probe lower, or whether we are finally going to get a bottom and continue to build on the positive price action from the last couple of days and make our way back above our moving averages. As you can see, so the 20 and the 50 pair moving average, we've discussed this quite a bit over the last 2 or 3 months. This idea that these moving averages, when they are running parallel at a 45-degree angle like this, they're like train tracks, showing that the market is in a very strong uptrend and really propelling the price action forward. Now, we're getting a change here, right? You can see the 20 is curling back down, the 50 is flattening out, and we're starting to approach the period where the 20 might be able to cross the 50 back to the downside. Now, that, of course, would signal an end to the very strong uptrend that we've had. Doesn't necessarily mean that the market is topping out, but what it does mean is the market has definitely lost its momentum upward and is reached the point where it needs to trade sideways and continue to chop back and forth until we have enough buyers to come in and push the market back up, or vice versa, we don't have enough buyers and the selling pressure continues to mount, in which case these things will continue to roll over and price action will follow back down maybe to the 200-period moving average and possibly even lower. So that's one thing to keep an eye on, is how these moving averages behave. Now, of course, they're really just following the price action. They're just an easy way for us to kind of envision what the price action is doing. So basically, if the price action continues to flounder about, these moving averages are going to roll over and head back south. And at that point, the price action will likely have headed south before it, but we'll see it coming. Now, if we can get the price action to start getting back above the 50 and make its way back to challenge the 20-pair moving average, that likely means that we'll see them flatten out, and more likely than not, what it'll mean is that we'll just kind of trade sideways for another week or two, and then we'll try to make another run right back up towards highs and see whether we have enough buyers to support that and push it through. If not, then we come back down and we'll continue to test these floors. So I think the key to take from this is that the market is likely going to be range bound for the foreseeable future. I think that the upward momentum that we've seen is probably done for now, and what we need to understand now is that we're probably in a range-bound environment. What that means is we shouldn't expect breakouts at highs to work very well. We shouldn't expect breakdowns at lows to work very well. What we should be expecting right now is stocks that are at support to likely find a bounce, and stocks that are at resistance to likely stall out and turn right back around. And so that changes our strategy, that changes the way we want to trade. We don't want to trade momentum right now. What we want to do is we want to trade reversion. We want to trade mean reversion. So if we see a move of 3 or 4 days going in one direction, we start looking at maybe trading in the other direction, and vice versa. Now, if the market continues to head south, you might tell yourself, well, that means that we should be looking at shorting, but I don't think that we're there yet. And I think that if the market does head south, all it means is that we'll start to reach an overbought status where buying the dip and trading a reversion to the long side becomes even more appealing. So for the moment, if we continue to drop, if this bounce that we saw is just a temporary 2 or 3 day bounce and we head further south, then again, rather than trying to short that, what I'll be looking at is trying to buy the dip and making sure that I'm getting good risk reward on the shots that I'm taking to the long side. As we'll get into the Qs in a second, and we'll take a look at the FANG stocks and we'll see where they are, and we'll see that a lot of them are underperforming right now. And well, that might be a sign that the market is struggling. And as I mentioned last week, there are signs that the market is starting to struggle a bit because there are a lot of stocks that are not doing quite as nicely as what we see on the overall market ETFs. However, once we have a turnaround, those things will start to shape up, and I think the FANG stocks in particular will see start to gain some momentum back to the upside. But we'll get to them in a second. As far as the key levels on SPY that we should probably concern ourselves with, so this 342 now becomes a pretty significant resistance zone. That was the level that we looked at last week and the week before that, which was, this is actually a very important price point because again, it was on that day that we finally broke down, that was the low of the day, right? And then the next day, that was the close. And then the next week, that was the highs that we couldn't break past, which of course coincided with the 20-pair moving average. So there's a lot of mounting evidence that this is a level that the market is not really ready to trade past. So if we get back to that price point, like I said, if we consider the fact that we're probably in a trading range right now and in a market that is range bound, that should be stiff resistance and should be a place that we probably want to be taking profits at, rather than trying to push through and look for a breakout. Now, of course, a breakout can happen, but if that happens, that's fine. We can always readjust and get back into plays depending on how it behaves. But for now, I'm treating this as a short-term wall that I don't expect the market to get past on its first attempt to do so. And if it does, well, there's another bigger wall, of course, at all-time highs. And considering the distribution that we saw at these price points, again, I don't expect us to break past that. Now, to the downside, I think 320, again, is still a good floor. If we take a look at what we've done this year, I think we probably need to go to a weekly chart for that now. And what I'm going to do is kind of zoom in here. So this 320 level was kind of important at the end of last year and the start of this year. That became a nice little floor for us as we started to build up and really start to rally. And as you can see, once we broke that level to the downside, that's when things really escalated. Once we got wind of what the coronavirus was going to do to our economy, and that's when we really shot down to lows. And we've made our way all the way back to that level. As you can see, it was actually the one spot where we really started to trade sideways this year was as we attempted to break through 320. We eventually did so, and that's when we started this little string of rising wedges that we'll see more clearly on the daily chart. And we've now come all the way back down to that level. Now, these areas that were previous resistance, and actually was even previous support before, so it's a critical level on both sides, but it was pretty decent resistance back in June and July. It should now serve as support, right? They often flip back and forth depending on what side you're on, right? So we go back to the daily. We get a better picture of, again, what we've done over the last 6 or 7 months now. You can see we're heading right back down to that level, and that should act as a good floor for price action. So even if we falter here, even if we can't get back to this 342 or so, let's say we hit the moving averages and we fail there, which again, this is actually a short-term level of resistance as well, is this 334, 333, which is the floor for the price action over the last couple of weeks, as well as where the moving averages are likely to cross. That's going to be an important area for us to try to break through. And if we fail that and we head back down to 320, well, then 320 becomes the support level that becomes important for us. And that's the level that we're going to have to really pay attention to. If we lose 320, it's a short hop and a skip to the 200-pair moving average. And I don't expect us to really break through the 200-pair moving average. So that would be the last level of support that we can trust as far as longs are concerned. If that was to fail, then we'd be in a whole different market. But for now, like I said, I think that 320 is okay and likely to be the level of support that holds as we start to trade sideways. And is really where I would be considering stronger buy the dip plays than what I'm doing right now. Like I said, right now we're being very picky about what we want to buy the dip on, and they're basically stocks that have very good risk reward and have very clear entry and exit parameters. Um, if we came down lower into the 320 level, I'd still basically follow those rules, but I'd be a little bit more forgiving on exactly what the entry exit parameters are, because I'd be expecting at that point to have stocks at very good value areas where I'd be willing to assume some of the risk in buying them, and that would be for longer term trades, not necessarily just for short term swings. But for now, we're just looking at short term swings. I don't think the market is corrected enough for me to get that excited about long term holds. But if we do get another shot to the downside, then I'll start looking. I'll definitely be more aggressive about looking at long-term entries. But for now, we're still concerned with short-term swings or intermediate-term swings. And like I said, I think 320 should be the area that we look at as the floor. And if we do head back to that level, I'll look for some reversal patterns. Now, the more likely scenario is that we try to make our way back up again to 333 over the next 2 days or 3 days. And from that's really going to be the key area is, can we break past that and get back above the moving averages? Like I said, I don't think we break 342, but if we can get back above 332, 333, then, it's still positive, and it still shows that maybe we bottomed out and just need to build up some momentum and build out a range before we're ready to challenge 342 and start climbing up again. If we falter and roll right back over, then like I said, I think 320, which we actually fell short of this time. If we come back and test it again, then I think at that point we can look at buying the dip again and looking at more long plays. So that's what that's what SPY looks like and what the S&P 500 looks like. And I think generally speaking, what the markets look like. As we go through the different ETFs, we'll see slightly different pictures, but most of them are kind of following along the same pattern. And I believe that's basically what the market's doing. And like I said, if you look under the surface, there's a lot of names that are maybe correcting a little bit more than this, but generally speaking, they're doing the same thing. All right, so if we look at the Nasdaq and we look at the ETF, the Qs, and we'll see basically the same sort of scenario, right? Where we had the big drop, same thing. That 320, that 283 is going to be kind of a critical level, just like it was the 342 on SPY, which again was the low from that Thursday move, the close on Friday, and then the next week or two we couldn't get back above that level. We're back below the moving averages, the 20 and the 50, and in this particular case, we are trying to hold above what was resistance and what has been kind of acting as support right now. As you can see, we actually fell below that, and right now we're trying to hold above it with a string of hammers here. This is pretty important. Now you can see the Qs, to a certain extent, are outperforming the S&P 500 because they're back above the floor from the price action of the last couple of weeks, right? Where if you look at the S&P 500 and you look, and I'll draw a little trend line here just to kind of outline it. You can see the S&P 500 is trading below that level, right? So the Qs are starting to pick up strength and starting to lead a little again because they're back above that. And are likely to still be the area that we want to focus on for bounce plays. This has been a theme throughout the year, and it's probably going to continue for the foreseeable future. So if you're looking for strength and you're looking for names that you want to trade to the long side, I think the Qs is still the best place to look at probably, and looking at some of the big tech names, which we'll look at in a second. Now, other than that, it's basically the same as the S&P 500. If we can get back to 283, 284, that's likely going to be a wall in the short term that we can't really push past. If we falter here, if these moving averages knock the price action right back down, then we're probably going to head lower. Now, you'll notice in this particular case, and if we go to the weekly chart, you get a clear picture of just how strong the Qs have been. So that red line on the S&P 500, which was the support level from earlier this year, it's way down here, 217 on the Qs, right? Our previous all-time highs are at 236, and we're still way up here in the 260s. So generally speaking, this is one of the reasons why I think our bull market is still intact, despite the fact that we are selling off a bit, because there's so much room to the downside on the Qs before any of that is really threatened. And the Qs have been the leader as far as bull action is concerned. So generally speaking, as long as the Qs are behaving well, we can assume the rest of the market is going to follow suit. Um, so if we go back to the daily chart and again see where we are, the rarefied air, you can see that we've got a lot of room to go down before we even have to worry about whether we've broken below our previous all-time highs. So overall, things are still very positive here. And like I said, this probably leads me to believe that if we do continue to see selling pressure, it likely means more that we're going to be trading sideways and range bound rather than rolling over and topping out. It's going to be hard to find something that's going to impact the markets as negatively as what we've already experienced this year. And so in my mind, I think if we do continue to see selling pressure, it's going to lead to sideways price action. And it'll just be a matter of the market trying to find what the bottom is or the floor for its potential trading range as we head into the next couple of months, particularly as we head into the election. Now, what are the key levels that we can look at? Like I said, 283 is critical, and it's probably going to be a short-term wall. We're at an important level right now, 270, and then the floor likely to be somewhere in this 255 area if we continue to pull back and we sell off and we have another leg down. We could head below that, and I think the real critical support here is all the way down to 237. But because the Qs have been stronger, I don't expect the sell-off to really push us down to that level. Now, if that happens, that's a pretty big change in the character of the market, and that's a lot of volatility that comes in. And so we might have to readjust our what our take is on the market. But I still think that's probably going to be an area where we can expect a strong bounce. So even if the market does sell off to that level, I'll likely consider it a good buying opportunity. And like I said, probably more along the terms, along the lines of long-term buying, rather than as just looking for swing trades. But I don't think we get there yet. I think that if anything, if we do pull back, it's going to be just another leg down as we stair step a bit and maybe head down to the 255 area. But we'll see. I think today's close is important. We'll see whether we can hold back above this 269, 270 area. And if we can get back above the 50 over the next couple of days, like I said, I think that bodes well for the markets to be able to stabilize and start to come up and re-challenge this resistance area around 283 on the Qs. Now, let's take a quick look at the FANG stocks before we move on to the Dow Jones. If we take a look at Facebook, again, you can see that it's underperforming quite a bit when you take a look at where it's at compared to where the markets are at. Remember, we can take a look at what happened that Thursday and that Friday and judge where we are compared to that zone, and you can see it's been kind of a free fall. We look at Amazon. We'll see again a similar picture of a market that's struggling to maintain itself. Now, in this particular case, Amazon is a little bit more like what the S&P 500 is doing. It's still kind of trying to find its way back into the range from the last couple of weeks, but ultimately we can see the moving averages curling right back down and starting again really close to crossing, showing that the market is kind of done climbing for the moment, or at least Amazon is. And if we look at Apple, again, a very similar picture. Very similar to the S&P 500 and to what the Qs are doing. Just trying to get back into that range from the last couple of weeks. You can see the moving averages again. The 20 curling down to meet the 50 from that quick move to the downside. Netflix and Google will be the last two, and we'll see, again, very similar pictures. Now, Google, a little bit different in that the moving averages are still kind of following price because it was climbing a little bit more slowly compared to what the others are doing. But generally speaking, it's still the same basic idea, right? We had the big drop, and then we traded sideways for a week and a half, and now we're trying to get back above the lows of that. And then finally, the last FANG stock to look at is Google. And as you can see, Google has kind of struggled as well, and is actually well below the price action from the last couple of weeks, and is kind of struggling to kind of maintain its positive action. You can see the 20 already, it's almost a foregone conclusion it's going to cross underneath the 50 at some point soon. So it looks like the uptrend is done on that as well. So generally speaking, if we look at the FANG stocks as an aggregate, all of them are performing poorly and are struggling. So that shows that the market has been struggling a bit. Now, like I said, you can come to two conclusions from this. One, you can say that, well, if these things are leading down, the market's going to head even lower. And that could be the case. However, I think if anything, what it shows is that this is what these things have already pulled the market down. And I think what we should be doing now is looking at these for a bounce. And if they bounce, the markets will come up with them. Now, if they don't bounce, obviously that means the market's going to head even lower. But we have pretty clear signals of what's going to happen here, right? So all of these guys have clear lows that have been formed, and they're not trading that far away from them at the moment. So I think at this point, while I wouldn't enter a long based off of the pattern I'm seeing today, I think all of these are good buy the dip plays, assuming we find an entry pattern and a reversal pattern around these lows that signal that we found buyers and are ready to kind of bounce. And so I think this is the area you want to look at if you want to really get a good read on when the market is ready to bounce. I think when the market is ready to bounce, we're going to see it on these FANG stocks and we're going to see it on the Qs. And then the rest of the market will kind of follow suit. There's only one other scenario that we could see in this place, and we'll get to that in a minute, and that's going to be with the small caps. Now, next up we have the Dow. And the Dow Jones, again, is just like the S&P 500 in that you can see what it's doing here. It had the same basic wall, right? So we had the Thursday low and the Friday close and the 20-pair moving average. And all of them coincided to form this wall that we just couldn't get past. And you can see it actually tried to break through it last week. And it ultimately failed, printed that little shooting star, and we headed right back down. And just like the S&P 500, we've had a nice bounce over the last 2 or 3 days, but we haven't been able to really get back above our moving averages, let alone the bottom of that range from the last couple of weeks, right? So everything that I said about the S&P 500 stands for the Dow as well. We can try to bounce here. We can get back above our moving averages. That's a positive. And it likely means that we just need to build up some buying pressure to get back into this 280 area and try to break past that. If we falter and fail here, then we're going to head lower. We're going to test probably the 200-pair moving average. Now, the one notable difference between the Dow Jones and the S&P 500 is in the long-term picture. The Dow Jones is still lagging. And again, you could tell by the red line, right? So this red line, again, is basically the same relative level on all of the indices. And you can see where the S&P 500 was compared to where the NASDAQ was. Both of them were above it, although the NASDAQ was way, way above it. Now, with the Dow Jones, if you take a look at the support level that we had at the beginning of this year, and we'll kind of just scroll back out and take a look at where the support level was as we started to really push to new all-time highs before the coronavirus, we're still not back above that level, right? So, relatively speaking, the Dow is still lagging behind the S&P 500 and the NASDAQ, and is still trying to get back above that, and it's not really able to do so at the moment. So, we can't look at that as a potential support level like we did on the other two. In this case, instead, we're going to have to look at the 200-pair moving average. We're going to have to look at this price action that occurred back in June and July, where we had a correction and then we kind of made our way through that. And you can see that this level here around 262, 263 was kind of an important level where we were able to kind of break out of our downtrend and then start to climb above it and then use that as a floor and kind of launching point to really push past and try to challenge that 284 level, which we were successful for a few days and then eventually rolled right back down. So if we do turn back around and head south again, then that level around 262, which is now the 200-pair moving average, should be support. Anything below that becomes suspect. And we probably head back down into the 250 area. But at that point, then, the markets and the Dow is trading under the 200-pair moving average, and that's a different ballpark altogether, and at that point we have to readjust and reassess exactly what we want to do with our trading in that particular scenario. So for now we want to see the market hold above 263 on the Dow, and really if we can get back above 275 and start to kind of chop through these moving averages, I think that's the more bullish scenario. But if we do falter and head back down, I think that we're still going to get good buying opportunities as we approach the 200-pair moving average. And then finally, the last index we want to look at is the Russell 2000, which is the small caps, and of course through the ETF IWM. And again, just like the Dow, you can see the red line. We haven't been able to break through that. It's been a very big resistance zone that the small caps have not been able to push through. Now, the small caps showed some relative strength last week, right? They were able to get back above this green zone, this 153 area, which again was the low from that Thursday and the close from the Friday after we kind of topped out. And they were able to actually push through that, and showing that there was some rotation as traders were willing to accept risk and try to get involved in some of these small caps as they picked up some momentum. Now, unfortunately, that momentum was short-lived, and the small caps have once again resumed their normal role as being kind of the bottom dwellers. And we're right back down close to the 200-period moving average and below most of the floor from the last couple of weeks. So right back to where they normally belong. So the other scenario I discussed that I was mentioning besides the Nasdaq leading the way higher is it's possible that the small caps once again gain a little bit of momentum, and we have rotation coming back in. Now I think it's not that likely, because if it was, it would have continued already through what we saw last week, and it looks like we've already reset back to the small caps lagging behind. But there is a small chance that the small caps start to lead us higher, and if that's the case, then we'll see a quick bounce here and a move back through the moving averages. And what'll happen is, in that particular case, the FANG stocks will continue to kind of just be sluggish and kind of struggle to really bounce. And again, I don't think that's going to be the likely scenario, but that is one potential scenario that could play out, although I think at this point it's going to be a little bit lower probability of that actually happening. But that would be the only other scenario, I think, in which case we could see a leader trying to push the market upwards. Now, more likely than not, what's going to really happen is that the Nasdaq is going to be the one that leads higher, and IWM tries to follow suit. And as you can see, it's got some work to do because it's going to have to get back through its moving averages. In this particular case, we have that's not the trend line I wanted to grab. We have a pretty clear downtrend in place, right? And so that's going to be some extra price action, some extra sentiment that the small caps are going to have to break through, which is going to coincide with their moving averages. So chances are very strong that if we do get a bounce in the next couple of days, it's going to end here at the 153 zone. So one thing I didn't mention earlier that I'll mention now is, like I said, I think we're in a range-bound environment, and where you want to look at mean reversion. You want to look at buying support and selling resistance. The other thing I want to point out is typically you want to be quick and aggressive about taking profits in these types of markets, because there's not a lot of room to the upside before we hit major turning points. And so if this trend is going to continue, we're going to continue to correct, well then we don't have a lot of room to the upside here on IWM and on the small caps. You're going to see we've got a bounce of maybe from 147 to about 153, at which point we're going to hit the two moving averages, which are now curling downwards, as well as this trend line showing that sentiment has been kind of bearish on IWM since back in August. So the likely thing that's going to happen here is if we do bounce, we're going to sell right off as soon as we hit this 150, 52, 53 area and head right back down and test support again. So that's a pattern that's likely going to play out on all of the indices. So we have to make sure that as we trade these next couple of weeks, we are quicker to scale out, and maybe not so, that doesn't mean you don't want to try to get as much profit as you can and throw your stop up on stocks that are performing well, but you also want to make sure that you don't get a nice move and then get greedy and expect more, and then we just hit a resistance area and we revert right back to the mean, because the market is chopping sideways, which means a lot of stocks are going to be chopping sideways. So that's an important thing to take out of this, is make sure that when you are trading in a range-bound environment, which is what it looks like we're in right now, that you understand what the market is doing and what stocks are going to be doing. And more than anything right now, what we have is you have buyers and sellers that are unsure of what's next, and when you have that collision between the two, you have these cross currents, which leads to kind of muddy waters, and it makes it difficult to really get a clear move or trend to work in your favor. All right, so that's the four major markets. Let's go ahead and take a quick look at the U.S. dollar. It's actually starting to pick up some steam. You can see a big move up over the last 3 days on the UUP index, and we're seeing this across the board, right? So if we look at the euro-US dollar cross, you can see, and again, in this particular case, up is good for the euro, down is good for the US dollar. So you can see that 3-day move where the euro has started to tank a bit as the US dollar has finally picked up some strength. and it was able to push right through the bottom of this range. And I think overall showing some good strength now. Still has some work to do to really recover and get back to where a better level. But I think generally speaking, we can see that the U.S. dollar has gained some strength. It also has gained some good strength against the U.S. Canadian, as you can see with the big breakout here. This was a nice move, and this was a pretty clean trade to look at, where we had the downtrend and we had the break of the downtrend. We had this little kind of bull flag, and then eventually volume expansion and range expansion as it started to really push upwards. So, big move out of the U.S. versus the Canadian. And then really the only one that's kind of not the same is the U.S. versus the Japanese yen. And even that one, very nice 3-day move, but overall still kind of near lows, and still needs some work to do to get back into its previous range. But generally speaking, the U.S. dollar finally strengthening up a bit, and we can see that reflected in gold, silver, and oil. You can see gold broke below its floor. And again, over the last 3 days in particular, as the U.S. dollar has rebounded, GLD has really struggled, and at this point is trading below its range, which of course is pretty negative. SLV is going to be very similar, as you can see, with a pretty big drop. And then finally, oil is also looking very similar. And again, we need to do a different thing with oil because we still have that wick that we need to get off the chart. But if you look at oil, and you look at what it's done since, say, about June or July, you can see it was building up steadily to get back above 41. It was able to get above 41, and for a while it held and made its way all the way up to about 43, almost 44. And then finally we saw the selling pressure come in, right? And that was a sign that maybe energy demand had finally reached a point where it wasn't ready to push through. And at that point, we've had a pretty significant drop. We had to move from 42 all the way down to 36. We found some buying and some support, and it made its way right back up. But you can see again, ultimately, it's kind of struggled, and it hasn't been able to get back above 42. Had another correction, and looks like it wants to take another shot at 42. But generally speaking, it has struggled a bit as well. Now, this one hasn't been quite as inversely correlated to the U.S. dollar as gold and silver. But again, struggling a bit as the U.S. dollar is picking up some strength. And we'll see what happens now as it makes its way right back up. But, oil, it looks like oil is still struggling with a ceiling at the moment. And again, the daily chart is not something we can look at until we get past this March level. And, I mean, it looks, here we get a better picture, but I feel like it's still kind of stretched out and squeezed out a bit compared to what we could tell with the 4-hour chart. All right, so that's my analysis of the markets and the commodities that I like to follow. If anyone in here, I think we only have one guy right now, whoever you are, if you have a stock you want me to look at, feel free to type it into the chat and we can go ahead and take a look at it. This week, like I said, has been a little bit of a struggle. We've had a couple trades working for me. I'll highlight one of the ones we were looking at. So we're looking at Citrix. And we're looking at Citrix as maybe a false breakdown, looking for a move to the upside. And so again, this is generally what I'm looking at this week as far as understanding where our risk-reward parameters are and the clear signals that tell us our trade's going to work or not work. So we're looking at stocks near support that are actually doing well this year, right? And so Citrix, as you may or may not know, they run the software package GoToMeeting, which is an online meeting platform. And while they haven't done as well as Zoom, because Zoom seems to have been the popular choice this year, if you take a look at what Citrix has done this year, it's been a very strong stock. Even when we had the coronavirus, it only dropped a little bit because, truth be told, this is actually fairly insulated to the impact that was going to have on our economy, and if anything, benefited from more people having to work from home and having online meetings. So it had a quick correction, but after that it zoomed right back up and started trading near new highs. Now, after that, it's actually been range-bound basically all year. Just trading with a floor of around 135 and a ceiling of around 155. Now, there's been a couple of moves back and forth through that, but for the most part, this has been a 135 to 155 stock. And so what I saw here was we were finally breaking below that range. And so this is what I'm going to say about what I was discussing earlier today about understanding what my entry parameters are and when I would enter a stock and why I would enter it. And so in this particular case, when we were looking at this on Monday, Citrix was actually trading below a very critical level. So at this point, I wouldn't enter this stock, right? This is not something I want to enter as it broke down and is trading below support that has held it for basically, 6 months, 7 months? So what we were looking for was support to hold on the 200 pair moving average and confirmation that this 135 floor is still intact. And for that to happen, we need to move back to the other side. Now, on top of that, we had our short-term downtrend, this bearish sentiment that came in as we started to bounce, and then you saw the volume and the volatility expand here. And this, of course, occurred with the market finally correcting. And we had this move to the downside. So what we want to see is we wanted to see Citrix break that downtrend as well as get back above this 135 floor. And it's done so over the last couple of days. Now, we haven't seen a strong move yet, but it's back on the right side of the price action. And so what we have here is we have very clear entry parameters. I don't want to get involved unless it can break these two trend lines. It breaks it, so I'm involved. If it breaks back below that, then I'm not involved and I stop out. If it does continue to work in my favor, well, we've got clear levels here now, what we want to look at, right? We want to look for a move through these moving averages, and we want to look for a move back into the 149 area and then into the 153.54 area. And we have clear scale out levels that we want to target as we move our way upwards. And so we have a stock that gives us good risk reward, right? Because you're looking at from 135 to 132, you've got maybe 2, 3, 4 points of downside, but we've got 10 to 20 points of upside, assuming this can make it back to the top of its range. And so that's kind of the trade, and the way I've been approaching this week is looking for stocks like this that are at support. They may not work. Chances are they probably won't work, but if they do work, they give us really good risk reward, and more importantly, they give us very clear entry signals that tell us they're trying to work rather than us guessing and trying to buy a stock before it's ready to move. And so that's been my approach this week, and the way I've been kind of looking to trade. And really the approach the last couple of weeks, because the market has been in a very similar spot as it was over the last couple, like 2-3 weeks. And so we've been looking at a lot of the same setups where if the market bounces, then these stocks should bounce with us or with it. And if they don't, then they shouldn't even give us entry signals, which is one of the stocks we went over last week was where you have a perfect setup, but if it doesn't give you the entry signal, you don't get involved, and it keeps you out of trouble. And that was what we did last week with Carnival, where we had a really nice setup, but because we had very strict entry rules, and it never actually broke the levels we were looking for, we didn't have to take a loss, and the trade didn't work out, but we never got into it, so we didn't have to worry about that, because we understood what was happening here, and if it wasn't able to break through that, then there was no reason to try to get involved in the stock, right? And so that's what we've been looking for, is for trades like this where you have a bullish opportunity that could play out in your favor, but until the market tips its hand and tries to do what it's supposed to, you don't need to get involved. You don't need to get in early and hope that it's going to work in your favor. You don't want to let that fear of missing out kind of taint the way you're trading. What you want to do is make sure that the market tips its hand and the buyers show you what they want to do first. And ultimately, the trade that I was looking at here on Citrix might not work out, but we've slanted the odds in our favor by waiting for the market to tip its hand and show that there were enough buyers to get it back above these two critical trend lines that were indicating that there was a lot of selling pressure it needed to overcome. And at the moment it's overcome those, but now it just needs to continue to push through and overcome some of this other selling pressure, which again I think will happen if the markets stabilize and try to get through their moving averages. If the markets don't, then there are going to be very few stocks that actually try to continue to move upwards. All right, so I think that covers it for today. Anyone that's going to be watching the recording of this video, if you have a stock request or any kind of question you have, you can always ask me on Twitter. I'll be more than happy to send you the answer through that medium, and help out as best I can. Hope you guys have a good rest of this week, and we will meet again next Wednesday.